The July trade deficit at $31 billion has made the current account deficit a serious problem. With this July number, the April-July or 4-month trade deficit has now touched $100 billion. At this rate of $100 billion for 4 months, the annual goods deficit or merchandise trade deficit can touch $300 billion. Now, India's services exports like software plus private remittances has hit 150 billion last year. Okay, let's assume a 20% growth, which is a very optimistic growth. We will still reach $180 billion. So a current account deficit of 120 billion looks like a given. Now, how do you finance it? Foreign portfolios, FPI, have been seriously negative till the month of June, as you can see. And they've turned mildly positive for July and August. So economists are assuming that net capital inflows, after accounting for FII outflows, may be at best at 60 billion. So as we said, 120 billion current account deficit gap can be financed half, 60 billion, by capital flows. The balance 60 billion balance of payments deficit means a monthly deficit of $5 billion, and it is this 5 billion per month or 60 billion the full year that may pressure the rupee. So is 80 for the honor per dollar back on the table? Can a fall in commodity prices ameliorate the situation, or can it even get worse? For all these questions, we are joined by Mr. D.K. Joshi, the Senior Director and Chief Economist at CRISIL, Upasana Bharadwaj, Senior Economist at Kotak Mahindra Bank, and Aditi Nayar, Principal Economist, ICRA. Ladies and DK, thank you very much indeed for joining me. Upasana, let me start with you. What are you estimating? Is the math that I put on the table correct? Do you also fear we could have, a balance of payments deficit of 60 billion or more?
Lata, your numbers are kind of close to what our own estimates are. Our current account deficit is at about $116 billion. And alongside, we are slightly more pessimistic on the capital flow. So we are at $40 billion. So, roughly the BOP deficit is working out to be about $75 to $76 billion for the full year. So our net BOP deficit is much more than what you just put out. Clearly, the pressure is there. But I'd like to just point out one thing, that the July trade deficit is something which hopefully, and our estimates do suggest, that they are the worst in the series that we've seen. And going ahead, the moderation in the commodity prices and the slack that we expect in some of the commodities, I think we should see relatively lower trade deficits going ahead. That is not to say that the trade deficit is going to become comfortable enough. It will remain elevated. The descent will be low, but it will be lower than the current rate. So to assume a similar annualized rate for the full year, the trade deficit.
No, one minute. I'm not assuming 31 billion a month. When I say 300 billion, we are assuming only 25 billion a month.
Yes, so I expect that to come down. Right, I expect that to come down slightly.
And you're expecting capital flows to be worse than the 60 billion, I'm assuming.
Right.
Okay. So there is still a problem. DK, Upasana has pointed out that things can ameliorate if commodity prices fall. But commodity prices fall indicate kind of recessionary conditions or slowdown in the destination economies. And, the engineering goods, etc., exports will come up on the screen. Our engineering exports have fallen by 2.5% year on year. Textile exports, cotton and made-ups have fallen, 28% year on year. If that is, so whatever benefits we get from fallen commodity prices, do you think that will be countered by lower exports itself?
Yeah, of course, it will be countered because exports are highly sensitive to global demand. They have a very high elasticity, and we all know that global growth is slowing. And as you rightly mentioned, I think it's already showing up in some of the commodities. And the weakening of the currency doesn't necessarily help much in this scenario. And I think even in the past, we have seen that even when rupee depreciated sharply, it did not help exports. Actually, the dominant driver of exports is global demand. So exports will have pressure from that side. And then I think then third element which plays out very mildly though is I think some of the trade policy measures like imposition of windfall tax. I think that kind of puts pressure on exports for petroleum products. And I think similarly, I think the steel exports where the duties were raised.
Yeah.
And I think that what that does is I think that discourages steel exports. So I do expect both. I think part of the windfall tax is already taken back, and steel exports, as if the prices remain stable, can be taken back. So there'll be some. So there'll be some counter force from this side, but overall, I think the story on exports is of weakening, and this is very clearly visible in the data for this fiscal year. I mean, if you look at the trade deficit number for April to July, it is 81.5 billion, which is 2.5 times of what it was in the same period last year. Similarly, if you take the oil out, it's not just the oil that is causing the problem. If you take the oil out, then I think the non-oil trade deficit is 3.1 times in the first quarter compared to same period last year. And similarly, if you take gold out, the trade deficit doesn't come down that much. I mean, so basically the point is that there is the imports are sticky and exports, I think, respond more to global demand. So in this scenario, it's not surprising that the trade deficit continues to rise. And I think on the services export, I think there are again opposing factors there. I mean, one is the IT/ITS sector, which could get impacted by global weakness in advanced countries. But on the other hand, I think the recovery that is taking place globally is more services oriented. So we might get some, I think, tourism and these kind of services might do somewhat better. So but I think overall story is that you're going to get a current account deficit above $100 for this fiscal year. And I think unless financial conditions improve, I think the financing would not be met by the capital inflows.
Got that. The bigger problem is whether it will also be next year, and that's what the rupee traders may think about. But Aditi, you know, what DK is pointing out to is that our imports are very sticky. Is that the big surprise or point that is coming out? Our economic growth is very good, and that is reflecting in this huge surge in imports. Look at the electronics imports and crude prices. We see $21 billion of crude imports. Clearly, we have got cheaper Russian crude. We know the data over there, and crude prices had ebbed a little in July compared to June. Looks like our volume must have been higher. So would you worry that imports are not going down even if commodity prices fall?
Yes, Lata. You know what happened interestingly in July is that our net oil imports are actually much higher because our oil imports stayed at an elevated level. But the oil exports came down very sharply, which is possibly as a reaction to the cess changes and the tax changes that happened over the last month. Now, going ahead, I think $31 billion is certainly an alarming figure, although I do hope it's going to end up being an aberration. We certainly weren't expecting it to be this high. And just to keep in mind, this is a month where gold imports have not misbehaved. So there is still a concern that in the months running up to the festive and the wedding season, we could end up seeing some additional pressure which would come in from the gold imports as well, which would be temporary. Now, overall, I would say that, again, if we compare year on year, the big culprits that have really led to the increase in imports are the energy pack, both crude oil as well as coal. So some moderation in commodity prices is definitely going to help our imports. I think the question, like Upasana and DK are pointing out, is to what extent will the lull in global sentiment really dampen our merchandise and our services exports? So $31 billion, I think, is an aberration, but I think 25 billion per month on average going ahead may be reasonable. I suspect that the Q2 numbers are going to be really quite terrible as far as the overall current account deficit is concerned. We're pegging the Q1 CAD at around $30 billion. Q2 CAD could be well in the range of 35 to 40. So as a percentage of GDP, it's going to be higher than maybe even 4.5% of GDP. So Q2 itself is going to look really terrible. and hopefully some improvement with the lagged impact of commodity price correction will be there in Q3 and Q4.
What's your overall number, Aditi? 4.5, I have not heard. I mean, I've heard a little north of 3.5, but if
That's
it is...
Q2 alone.
Sorry?
That's only for Q2.
All right, fair enough. So you expect it to come down in the second half. Upasana, let's take the oil import numbers again, and they will flash on the screen for the benefit of our viewers. See, it's gone up to 21 billion. Now, clearly the government has realized that this taxes on petrol exports and diesel exports was perhaps going overboard on the inflation front, and they have pulled back those taxes. So hopefully they're expecting petrol exports will, or at least petroleum product exports will pick up. Even assuming that, see, 21 billion imports, even after crude prices fall, let us assume a 15% fall in crude prices, 21 billion still becomes only 17 billion. Even that is a large number. Our monthly gap is actually over 10-15 billion after we take out services exports, right? 31 billion a month. You subtract service exports of what? 15 maximum. You still have to fill 15 billion a month. And even if you reduce the oil imports by 4 billion, it's not a great deal. We still have to find the other 9 billion to fill the trade deficit gap. Is this math correct? That even if crude prices fall, we have a problem?
No, Lata, absolutely. Like I said initially as well, my balance of payment deficit is $76 billion. It's higher than what you said in the beginning.
Okay.
So clearly there is a funding issue. And that is something which we will have to worry about as we go ahead. Because flows are, apart from FDI, there's nothing much to really support capital flows. Current account deficit at, I would agree with Aditi to an extent that the second quarter will also be higher in terms of current account deficit. But my H2 estimates are relatively lower. I do expect on a net basis the impact of commodity prices to show up better in the second half of the year. And that's where I see a benign balance of payment reactions. But for now, in this running quarter as well, we are looking at a reasonable funding issue.
Okay. Well, more than the funding issue, I have something like a rupee issue and what can RBI do issue. Both those questions coming up to my guests in a minute after this break. Welcome back. We've been discussing the huge July trade deficit of $31 billion and its likely impact on the full year current account deficit and hence on the rupee with economists D.K. Joshi of CRISIL, Upasana Bharadwaj of Kotak and Aditi Nayar of ICRA. Ladies and D.K., we now have to discuss where the rupee is headed and what RBI may and can do. D.K., do you think that, until yesterday, the market was veering towards a 35 basis point hike because it looks like the Fed also may not hike so much and there was this recession expectation. Do you think now 50 is back on the table because of the currency, because the value of the rupee has to be preserved?
Well, I think our US economists tell us that Fed is aggressive and will stay aggressive. So I think we were on 50 basis point in any case, okay. I think. So we were seeing the RBI continuing with its front loading. And now I think with the trade deficit, I think you probably, I think that's indicating that that central bank, because what happens is when trade deficit rises, your current account deficit rises, I think your currency becomes more vulnerable, so to say, because the funding requirements go up.
Yeah.
And in this environment, I think one cannot be too sure of funding availability, okay. as I think was being pointed out by others as well. So I would say that I think central bank will go for a 50 basis point rate hike at this juncture. Although I think there is a little comfort on the inflation front, but I think there are many other pressures as well, I think, which monetary policy will have to heed to.
Yeah, at the moment, sentiment may warrant it, but let's see. These 24 hours seem to be a long time in financial markets. Aditi, how are you looking at the rupee? I mean, I'll come back. I want your RBI guess as well. But do you think rupee goes back 80 back on the table, 81 back on the table?
Radha, I don't think we can rule that out, because what we've seen with the rupee always is that a couple of days of bad news flow can certainly make it move, a couple of rupees to the dollar very, very easily. And I think in this kind of uncertainty, what we have, geopolitical commodity prices, Fed outlook, inflation rates, our own trade deficits, etc. We certainly can't rule out that the rupee will again try and test 80 and may temporarily cross it. But we still don't think that we're going to cross 81 in this quarter, or I would say in the next few months. And especially, Q2, like Upasana and I both are saying, we think Q2 is going to be a tough quarter for the current account deficit. And therefore, for the funding side, it's going to be a more difficult quarter. But things should turn back in H2. And I think that's why we don't expect 80-81 to become the new normal. It could temporarily see these levels, but we expect a pullback after that. On the MPC side, I would still be at about a 35 to 40 basis points hike in this review. We are in a data-dependent world, and we can always see a slightly bigger hike in September, a couple of months down the line, if that's what data says is warranted. But at this point in time, I think we do see a slightly softer inflation outlook than what was the case 2 months back. And therefore, I do believe that the size of the rate hike should be a little lower than the last.
So 35 is what you're going with?
Sorry?
What are you going with as a rate hike from RBI?
35 to 40 this time.
Okay, 35. Okay, that's a bit of a divergent view over here. Upasana, we also have to look at the other side. As Aditi was also pointing out, already they have taken off the export duties on crude, on petroleum products. There could be more proactive. The government also is going to be acting dynamically, and you could see even perhaps the steel export, tariffs coming off. So, there is that, and there is also the FII flows. We are suddenly coming back into the reckoning. So, are we discussing everything in an extremely gloomy scenario, and things can only improve from here? Is there a possible bright side which is very, very which is quite possible will play out?
Lata, bright is a strong word, I would say.
Okay.
But yes, I think improvement from where we are today. External sector imbalances probably are near the peak.
Okay.
We can put it across like that. And henceforth, in a month or two onwards, we do expect them to improve because much of the impact, lagged impact, I would say, would start showing up across trade numbers and across FPI numbers as well. I think what we are seeing is that much of the negative news has been largely front-loaded.
Okay.
And to that extent, near term still remains clouded with a lot of uncertainty, and beyond which there could be some scope for improvement.
Okay. Okay. Two quick numbers from you. What will RBI do on Friday, and what are you expecting on the rupee?
Rupee, clearly, I think we've seen a very reasonable appreciation right now. So we will probably remain in the current range. RBI has clearly made it, provided a very strong signal that they're not looking or allowing rupee to really move above 80. I think that's one thing very clear. So 78 to 80 is a good range to believe, for us to believe that in the near term we'll be there. But I do agree that there is room for depreciation again, but settle in a relatively narrower range because RBI's signal is such.
Yeah.
On the monetary policy side, we believe that RBI should continue to front load, and hence a 50 basis of a rate hike should be suitable at this point and get a breather eventually, even though their own estimates are going to be actual estimates are going to be lower on inflation than what they had projected in the previous policy.
Oh, you mean they will announce something lower than 6.7?
Yes, I think they'll be coming closer to 6.5. We've been highlighting that for quite some time now, so I think they should be lower.
Okay. Oh, in that case, the door opens for a bit of optimism on the bond front as well. But DK, your rupee guess?
Well, I think rupee will remain under stress right now, and I think as Upasana was pointing out, it has not weakened that much, unlike the taper tantrum or even the global financial crisis. So, but I think the good news there is that it does come back.
So what's your number?
Overshooting
80?
gets corrected. Yeah, so we believe, I think eventually by March 2023, it will definitely be below 80.
Okay. All right, out of time, DK, Upasana, Aditi, thank you very much indeed for joining us. Not really consensus on the table. It does look like there is a division between 50 and 35 basis points from the Reserve Bank on Friday. there's more commonality in terms of worries about current account deficit. But the good news is the bad news here. India's domestic growth has really surprised on the upside, and with the chip shortage declining, for all you know, the electronic imports will be even higher, and therefore growth could be our enemy as far as current account deficit is concerned. But there can be a slightly benign scenario that can play out, that FPIs who have returned in slow steps, in baby steps, could increase their inflows, and we may be pleasantly surprised on the capital inflows front. The balance of payments deficit may not be as wide as 76 billion that Upasana is pointing out. The government also could move dynamically, but at the moment that looks more like hope. At the moment it is a fear that we have a large current account deficit, and God forbid the market doesn't get the impression that it will continue even in the next year. Then there is genuine pressure on the currency. With that, we wrap up on this special show. Thank you very much for watching. Do keep it with CNBC TV18. Lots more news and views lined up for you.